Hi and welcome to Swissquote's daily market talk. It's Monday, November 11th. The US markets closed last week with fresh records. Bitcoin advanced past the $81,000 level over the weekend, and the US dollar remains in demand on Trump optimism. But sentiment is much less cheery for the rest of the world, to say the least. Chinese and European stocks, energy, and commodities are actually feeling the heat of the upcoming Trump tariffs. So last week ended on a very positive note for the US equity markets, guys. All major indices rallied. The S&P 500 notched its best week in more than a year and topped the 6,000 level for the very first time in history. The Dow Jones Industrial Index traded past the 44,000 level for the first time as well. Nasdaq 100 closed above 21,100 level, and small caps approached their all-time high level as well. And that despite some investors' pessimism that the Trump-fueled US yields could, backfire on small caps as they have smaller margin to shoulder this higher than otherwise borrowing costs. And indeed, the Minneapolis Fed President, Mr. Neil Kashkari, was among the first Fed members to, comment after last week's US election and the Fed decision. And he said that the bank could lower the interest rates less than previously anticipated. But he rather pointed at the strength of the US economy rather than Trump policies. He indeed said that it is certainly too early to determine the impact of what's to come in terms of Trump policies in the foreseeable future. If the new president favors tax cuts over tariffs, the US equities could then continue to surf on a wave of optimism, while focusing on tariffs before the corporate tax cuts would brush off a part of the present optimism. So voila, if you want a very, very quick summary of the situation. But for now, optimism prevails because during this weekend, the Trump optimism actually continued to show in Bitcoin prices. So the price of a coin spiked past the $81,000 level over the weekend, and the next natural target on the grill is the 100,000 psychological level that the bulls are eyeing right now. And that's the American leg of the story. The picture remains quite bullish for the US equities. So I insist on the US equities because the British FTSE 100 and the European Stoxx 600 indices, they both closed last week below their 200-day moving averages on worries that, a heated international trade environment could hit their valuations. And the Chinese leg of the story is much less dreamy too, because China announced after a week of suspense that it will deploy the 10 trillion yuan to refinance its local government debt as expected by many investors out there. Alas, the announcement failed to revive optimism as many were apparently hoping to see bigger measures deployed in response to Trump presidency, who is now expected to increase tariffs on Chinese goods to 60%. As such, the big banks are back to cutting their growth forecast for the Chinese economy. And the Standard Chartered and Macquarie, for example, expect the increased US tariffs to shave 2 percentage points off annual growth in China, while UBS just trimmed its growth forecast from 4.5% to 4%. And the economic data that was released during this weekend wasn't encouraging either, because consumer inflation in China came in line with expectations but remained soft, and deflation in producer prices in China unexpectedly accelerated last month to minus 2.9% on a yearly basis, and came as a mixed signal on the impact of the latest stimulus measures on the Chinese economy. As such, the CSI 300 index bounced lower last Friday and erased a part of last week's gains that were actually built on the optimism that the Chinese stimulus measures would, this time, please investors. And crude oil is under a renewed downside pressure as well since Friday, and the barrel of US crude is back to testing the $70 per barrel support to the downside, having erased past week gains that were actually supported by geopolitical worries of the Middle East, and hence that OPEC would delay the end of its production restrictions by at least a month. So remember, I was saying last Friday that oil bulls needed China to surprise investors by a strong fiscal stimulus announcement, and failure to do so is now waiting on oil this morning, and iron ore is also under a decent selling pressure, and the spot price slipped below the 100-day moving average, and the latter weighs on the Aussie as well. And elsewhere in the FX market, obviously the US dollar index remains bid, and it remains bid on rising uncertainties regarding the Federal Reserve's easing path. For now, don't worry, because the markets still expect the Federal Reserve to deliver another 25 basis point cut before this year ends. But that probability fell from above 70% to below 65% this Monday morning. The data, especially the inflation data, will gain importance moving forward as Trump policies, so the tax cuts and tariffs, are inflationary and will certainly limit the Federal Reserve's capacity to ease wholeheartedly. So this week, investors will focus on the next US CPI update that's due this Wednesday. And in numbers, the headline inflation in the US is seen steady near 2.4% level, and core inflation unchanged at 3.3% mark. And higher than expected figures could obviously further awaken and fuel the Fed hawks and support the US dollar bulls against major peers. And speaking of the major peers, well, the euro dollar is testing the 107 level to the downside this morning. The Trump's tariff threat on European imports has become one of the major drivers here as well, remember, combined with the troubled French finances and also the chatter of early election in Germany. Now, I believe that a further retreat in the euro dollar is still on the cards unless we see a surprise easing in US inflation this week. Across the channel, while cable looks like it has been taken away, its chance of hoping for a sustained rebound above the 130 psychological level, the Bank of England's less dovish stance after the UK budget is countered by a broad-based strength in the US dollar. But sentiment in the euro pound reflects well this divergence between a more dovish European Central Bank expectations and less dovish Bank of England expectations, and the latter points at a possible and probably a sustainable advance in the euro pound toward the 0.80, 0.82 area. In Japan, the dollar-yen bulls remain in charge of the market as, in one hand, the Trump presidency is boosting the US dollar on less dovish Fed expectations, on increased inflation expectations. And on the other hand, the Bank of Japan's, no more rate cut plans for the rest of this year keeps the yen bears motivated, especially at the current level. So the only risk for the Japanese yen bears is the risk of a direct FX intervention that should come in play above 160 and probably not before. So you do have some margin to play around on that front. And on the earnings front, 91% of the S&P 500 companies have already reported their third quarter results, and 75% of them came up with a positive EPS surprise, and 60% came up with a positive revenue surprise, according to FactSet. This week, Disney, Cisco, Home Depot, Spotify, and the Chinese Alibaba and JD.com will be going to the earnings confessional, and we will have to wait until next Wednesday to find out how Nvidia did last quarter. But this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.